Hello again, this is Doc from OnTheMoneyOptions.com, and today's video is how a hedge works. We're beginning to see some rotation out of the energy sector. This may be some profit taken, and it isn't unusual after a strong run up. The sector performance chart below shows how the energy sector has underperformed the S&P 500 recently. I want to use this technical briefing to explain how our hedges work. I will use FTI, an oil and gas services company in the energy sector. We entered this position as FTI broke out of a long-term downtrend and the technicals turned positive. This happened when the energy sector was outperforming the S&P 500. With each option cycle, we have sold a covered call above the current price and used those funds to purchase a protective put. We call this a collar or risk reversal. At the end of each option cycle, I look for opportunities to move the put up. In this case, we have the current put level at $34 per share, the yellow arrow. This is above our $32.10 cost. The price of FTI has dropped recently but below our entry price. Regardless of what happens to FTI between now and the option expiration on February 17th, the put will protect the profit we have in the position. At expiration, I will analyze the holding to determine if we continue to hold FTI. One of two things will happen. First, the price may continue down, and it is determined an exit is in order. I will let the put at $34 execute, and the stock will be put at $34 per share. The covered call that we sold will expire worthless, and we keep the 77-cent premium we received for the covered call. That would give us a cost basis of $32.10 minus the 77-cent premium and brings it down to $31.33. The stock will be sold at $34, giving us a profit of $2.67. This would be an 8.5% return. FTI is a good long-term stock, and I may elect to hold it. In this case, we would keep the stock, the covered call would expire worthless, and we would sell the put for a profit. The put will be exactly worth the difference between $34 a share and the current price. Let's say the current price remains at today's current price of $31.29. The put will be worth $34 minus $31.33 or $2.67. We will keep the $2.67 profit and add it to the covered call premium received of 77 cents. This will give up a profit on the hedge of $2.67 plus 77 cents or $3.44 total. This has the effect of reducing our cost on the position of $32.10 to $28.66. On or just after expiration, I will put on another collar on the position. The cash from the options will accrue to the accounts. Unfortunately, the accounting systems at all brokerage firms do not show the reduction in the cost basis. The hedge is treated as a separate transaction. We may go through this cycle several times, but the cost of the stock will remain $32.10. Here's a screenshot of the current position. The stock is down $320 today, but the put is up $261. In the unrealized column, the stock position is down $416, but the hedge is up a total of $1,658 plus $853, equaling $2,511. This is how a hedge is supposed to work. We use the income from the covered calls initially to buy the insurance of the protective put. This collar does not affect the receipt of dividends while we own the stock. So until next time, this is Doc saying so long and stay hedged. Be sure and follow us here on Facebook for more useful tips and follow our YouTube channel for more helpful videos. Now, if you really want to learn how to do this, you need to go to my website, OnTheMoneyOptions.com, and sign up. We'll give you a free 14-day trial to see how we can help you become a more profitable and consistent trader.